Sticky inflation, an unpredictable Federal Reserve, and an AI Capex boom are pulling equity markets in opposite directions. Volatility has reset higher, leadership is narrowing around semiconductors, and policy risk is rising just as a new earnings season takes shape. Welcome to vTalkInsight, Equity Pulse Daily for June 26, 2026. Let's unpack what this backdrop means for equities right now. The macro story starts with inflation and the Federal Reserve. After several years of prices running above its 2% target, the Fed is again putting price stability ahead of growth or employment, and recent data are giving it plenty of cover. Core PCE inflation on a year-over-year basis has moved up to around 3.4%, the highest since last autumn, while the quarter-over-quarter pace has jumped to a 3-year high. That points to underlying pressure rather than a clean disinflation trend, and many expect core PCE to stay above 3% into year-end. Against that backdrop, rate expectations have shifted. A growing camp anticipates as many as 3 hikes, potentially starting as soon as July or later in the year, with some even assuming back-to-back moves ahead of the elections to rebuild credibility. At the same time, Fed officials are questioning the value of detailed forward guidance, and the new chair is communicating in a more ambiguous way. The result is a twist flattening in the Treasury curve, with front-end yields reacting sharply to each inflation print while longer maturities are steadier or even edging lower. The curve is now as flat as it has been since last spring. Flows into United States bonds and European bonds underline a bid for safety, even as some still argue the Fed may ultimately stay on hold this year. For equities, that mix means a higher and less predictable discount rate, greater sensitivity to each macro release, and more scope for policy to drive volatility rather than cushion it. Inflation is also fragmenting beneath the surface. On one side, energy is acting as a relief valve. Oil prices have fallen back toward pre-conflict levels, the curve has slipped into contango, and West Texas benchmarks have dropped below $70 as markets price a sizable supply surplus for next year. Forecasts for Brent crude have been revised down, with talk of an average price in the mid-70s and downside scenarios towards $60 if production surprises on the upside and Asian demand, especially from China, stays soft. That combination suggests ongoing pressure on energy equities and producer revenues, but it also eases headline inflation and supports real purchasing power for households and many corporates. On the other side, the stickier parts of inflation look much less benign. Services prices remain elevated and are not being driven by temporary moves in oil or tariffs alone. Deglobalization, new trade frictions, and onshoring are adding structural cost, while producer price indicators and supply chain surveys still point to upside risks rather than comfort. Crucially, the AI build-out itself is becoming inflationary. Memory chip prices have surged, electricity costs for data centers are climbing, and demand for reliable, low-carbon baseload power is accelerating investment in nuclear, storage, and renewables. That means oil-led disinflation is colliding with an AI and services-driven third wave of inflation, leaving market-based expectations looking complacent relative to recent headline prints. For equities, that mix challenges margin assumptions in energy and heavy power users, while rewarding firms with genuine pricing power. Turning to the equity tape, the S&P 500 has just come through a rare near 20% advance in under 10 weeks. Historically, such bursts have often been followed by further gains over the following year, but the recent price action looks more like a pause, with small daily moves and implied volatility holding in the high teens. Under the surface, though, leadership is not standing still. Breadth has improved, with more index members rising even on down days. There is a visible rotation toward financials, industrials, and healthcare alongside persistent interest in technology, effectively supporting a barbell between long-duration growth and more cyclical exposure. The banking sector is an important part of that story. All major United States banks have just passed the latest stress tests, demonstrating capacity to withstand a severe downturn. Dividend increases, including a notable hike from Morgan Stanley, and strong return on equity at names like JP Morgan, where profitability sits near 20%, reinforce the perception of sector strength ahead of what is expected to be a solid earnings season. But there are clear fault lines. Momentum strategies have massively outperformed defensives, raising the risk of sharp reversals if sentiment flips. European equities, buoyed by a softer stance from the ECB, cheaper oil, and robust United States demand, now embed record high margin assumptions that are highly dependent on continued AI-related Capex. At the same time, we have seen sizable outflows from United States equities into higher-yielding bonds. Put together, the setup looks like improving breadth wrapped inside stretched valuations and heavy factor crowding. The center of gravity for equities remains the AI infrastructure cycle. Enterprise spending on AI hardware and related infrastructure has accelerated dramatically, with growth rates stepping up from the high 20s to well into triple digits over a handful of quarters. Global Capex tied to AI is expected to surpass $1 trillion next year, and hyperscalers are still earning cash returns near 29% on those investments, despite higher funding costs. Micron sits right at that intersection and has become this week's key sentiment pivot after the semiconductor sell-off we saw earlier. The company delivered blowout quarterly numbers, with revenue far above expectations and gross margins in the mid-80s, and guided to sustained tightness in memory supply through at least 2027. Management has now locked in multi-year, floor-priced contracts with more than a dozen large customers, including major device makers and hyperscalers, effectively smoothing its own cycle and keeping pricing power elevated. Average selling prices for DRAM and NAND have jumped sharply, in some cases by 60 to 80%, and earlier quarters saw memory costs roughly quadruple. That is fantastic for Micron's profitability and has triggered rallies across Asian and European chipmakers, including strong moves in names like ASML. However, it is also squeezing downstream manufacturers. Apple, for example, has implemented broad price increases on Macs, iPads, and other hardware, in some cases in the mid-teens to mid-20s in percentage terms, largely because memory and storage costs can no longer be absorbed. Elsewhere in the AI stack, Qualcomm has gained traction as it pushes beyond smartphones into custom data center silicon, targeting at least $5 billion of infrastructure revenue within a few years, with upside scenarios several times higher. Industrial names tied to data center construction and grid upgrades, such as Caterpillar, Applied Materials, Western Digital, and Quanta Services, are reporting strong backlogs and expanding addressable markets. Yet this success also creates concentration risk. Recent S&P 500 advances have been heavily dependent on semiconductor and memory stocks, with Micron alone accounting for a large share of some daily moves, while mega-cap software and cloud names, including Microsoft and Oracle, have lagged as investors worry about core software momentum. Positioning around this theme is increasingly complex. Micron's valuation multiple looks low because earnings have surged and passive ownership now dominates, even as active managers and shorts grow more cautious in names like Qualcomm. Retail traders remain enthusiastic, aggressively buying dips in AI and memory stocks. Leveraged and single-stock exchange-traded products tied to high-profile AI names are amplifying intraday swings. Many observers still talk about an AI-driven bubble that could persist through year-end, supported by extraordinary earnings and Capex, but the same forces that power the upside also leave the broader equity market more exposed if the narrative cracks. The consumer side of the story is showing more strain. In Europe, H&M once again missed profit expectations and continues to lose market share, squeezed between ultra-low-cost rivals and faster-moving fashion peers. Broader commentary points to shoppers trading down in both the United States and Europe as persistent inflation and higher product prices bite. In private markets, liquidity looks less comfortable than public equity indices suggest. The Ares Private Credit Fund has capped redemptions again, echoing similar constraints elsewhere in private credit. At the same time, a wave of equity supply is coming through, with large Asian corporates seeking listings in United States markets and established tech firms tapping investors with new offerings. That surge in supply competes for the same pool of liquidity that is also being drawn into AI infrastructure Capex. Market structure is adding another layer of complexity. CBOE reports that its trading floor and S&P options volumes have grown hyperbolically over recent years, helped by both institutional flows and more sophisticated retail activity. New event-driven contracts and the rise of leveraged and single-stock exchange-traded funds, especially around volatile AI names, are making it easier to express short-term views, but also harder to manage risk as intraday swings intensify. Finally, politics and fiscal choices are never far from the tape. United States elections are stirring more populist rhetoric and the prospect of additional Fed tightening before November, even as actual policy follow-through on issues like antitrust or rate caps has been limited. In Europe, NATO members, including Germany, are lifting defense spending toward, and in some cases beyond the 2% of GDP threshold, but production bottlenecks mean delivery will be slow. The key signposts from here are the next core PCE prints, any shift in Fed tone on hikes versus pause, the durability of AI-driven earnings, and whether breadth can keep improving without another leg of index-level volatility. Stepping back, the equity market is being pulled between three powerful forces. A still hawkish, less predictable Fed is keeping the cost of capital elevated. Headline disinflation from cheaper oil is offset by sticky services and AI-related cost pressures. And an extraordinary AI Capex cycle, led by memory and infrastructure suppliers, is driving both earnings growth and new sources of inflation. Beneath a relatively calm S&P 500, leadership is rotating. Banks, industrials, and healthcare are gaining traction alongside select AI hardware and infrastructure names, while software-heavy megacaps, energy, and mid-market retail look more challenged. Market plumbing in private credit, derivatives, and new issuance is amplifying the potential for sharper swings if any of these narratives break. From here, the balance of risks hinges on how quickly core inflation cools, how far the Fed is willing to go on further hikes, and whether AI-driven profits can keep outpacing rising input and funding costs. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.